you go look at the Federal Reserve's reporting of household debt service ratio, which is something we followed a lot coming out of 08, 09, little quick history. If you look back at the data, often, this is what had to come in line to get out of deeper recession. So think of the S&L crisis, for example. We went from high levels of debt service in the consumer to much lower levels as we cleansed the economy from those circumstances. So 07 was the worst that data set ever got. By the pandemic low, we'd never been to the level that we were at. We have mean reverted to a higher level, but still the lows of the data since the Fed began recording that in 81. So here's how I think about this. To your point, is it pretty argued in the data right now that the lower end consumer doesn't have as much cash as they used to, and they're on tighter means? Yes, but so much the economy is being driven by the upper stratas of income that until that calms down, you can't get a bad economy. I'll add one more thing. Compared to all those other periods, you look in the data, you can't find a period where the U.S. government has ever spent this much in deficit. So to your point, yes, the consumer still has cash, especially on the higher end. The catch is that government spending, as Bessent has been arguing, they hope to get down to 3% deficits in 4 years. Hope, okay? There's no guarantee of that. And I think, to your point, that has blunted the economic realities far more than people think, which is why short-term rates rising a lot did not affect the economy like in the past, because ultimately there was a buffer.
So how do we play the trade then? Because the market is trying to reposition from everything they knew around the consumption trades, around technology. Yeah. Money's moved very aggressively in recent weeks, and even by and large away from U.S. assets. Yeah. How do we think about those moving pieces now?
So it's a really good question. Let me touch on one more thing. Don't confuse what's going on here with luxury in Europe to be the U.S. consumer. The luxury brands try to reach down market. That's failed, in my opinion. In other words, this marginal growth, higher incremental returns, I think that's failed. I think they're picking up the pieces of everyone kind of dreaming, about puppy dogs in luxury space forever and these lifestyle brands. Okay, so pulling that back, as we go one step further, I think the most intriguing thing to me is this idea that all these global investors are going to go get their money out of the U.S. equity markets as though you kind of just clip your coupon of equity returns every year. I think of the old story of the turkey. At 9 a.m. every day, the turkey gets fed. Except for one day a year, it finally gets killed, okay? And I think that's what we're beginning to see in U.S. equities, this idea that you're always going to make these outsized gains in U.S. equities. That game is done. And I point that out because there's just a lot of incongruities that you can see right now. Think of how much money's been made in European banks the last few years, as an example, okay? No one thought that was possible. We were visiting with Orchel last week, and it's just so obvious what he's doing. But it's obvious to someone who's paying attention to banking and what's going on in the industry. For anyone looking for broad equity returns, they completely miss those kind of things. So I think it's all about unique opportunities. For example, Ash Wednesday was the second best buying opportunity in the energy business of the last 20 years, okay, in our opinion. So I just say that because there's a vast difference between going after something like that, trying to predict whether DeepSeek or Jack Ma's new venture are going to go out and take out some of the opportunities that these big tech companies are playing for. Question on investment, lots of hyperscaling investment. I'll use Microsoft, $80 billion. The question for the U.S. stock market is what's the incremental profit and free cash flow? And as of today, it's zero.